David Blanchflower. He's a Dartmouth economist and a former member of the Bank of England's Monetary Policy Committee. And you're here with us
live
in person.
To see you rather than listening down the wire.
I know.
It's great to be here.
This is great. And thanks to Dartmouth for lending you to us today. I know you're here for the Bloomberg Link inflation conference this afternoon. And inflation is one of the factors being debated right now and in many ways constraining what the Fed, what European officials can do. Were you disappointed today that Trichet didn't act to stimulate the economy?
Absolutely. I think what's really interesting is that people seem to be focused on inflation today, but monetary policy makers have to focus on what inflation is going to be down the road. And it quite clearly appears to be that inflation is falling in future. And the ECB Rubini called it a major macroeconomic mistake this year, raising rates twice.
If you read
what Trichet said, the logic is you should be reversing this ridiculous decision. Growth forecasts slowing, inflation going away. What are they doing?
Well, what can Ben Bernanke do today? Because in some ways the stakes have been raised by Trichet's inaction this morning for what we hear this afternoon.
Well, Trichet's inaction has obviously impacted the US, but I think particularly today the OECD has really dropped the growth forecast for the US. So I think Bernanke is going to have to signal on the day that we're going to have the president speaking, we need some stimulus. We need fiscal stimulus, which may or may not get through. The president will announce it, whether we'll actually get it through and have it taking effect. So I think really Bernanke is the only show in town.
He's the only show in town, but should the government be the agency that's creating jobs or saving them?
Well, the difficulty is the Fed is actually a monetary policy maker.
Right.
It can impact levels of demand. But I think you're going to hear today, and I'm a labour economist, we have to try and get unemployment down and have to take realistic measures.
But is the Keynesian approach the right one to stick with?
Well, the problem is the other approaches don't seem to have worked. What we saw, in fact, was when stimulus was being put in, we got growth and we got jobs. And we got jobs being created, we got growth being created. As the stimulus came off, we've seen unemployment rising and growth falling. So it's really as simple as that. There really is very little alternative to putting in short-term fiscal stimulus, long-run plan to deal with the deficit, and short-run growth from the central bank, growth of the QE, I would say.